Sunday, September 16th, 2018, Monaco 64, home of alternative economics and contrarian views. I thought I would look at some figures, some charts, to maybe try to see what signals we need to look at to see if there is a next major financial crisis. I know there's a lot of people have been predicting crisis the last few years. And one reason I want to talk about this is because even in the mainstream now, they're starting to talk about this. I think earlier this week, I went out and I looked at some of the papers, and The Guardian had Gordon Brown, the former Prime Minister of the UK. He was also Chancellor of the Exchequer. It's like the Treasury Secretary equivalent. And he said that we could be due for a crisis and that things haven't really been fixed properly after the '08 crisis. And that's really funny because he was one of the guys in charge during when, everything hit the fan. And he actually bailed out, his government bailed out all the banks and the bad actors. So he's now coming out and trying to lecture people, which is, in my opinion, is comical if it isn't sad. And there's also I got some communications from my viewers. They sent me links of a story on Sky News, and one of the supposed economists, I don't remember her, never really heard of her, Ann Pettifor. She's saying the same thing, that we're due for a crisis because they happen every 10 years or so. Sometimes it takes a little longer, sometimes a little less. But it's been 10 years since the fall of Lehman Brothers. So I wanted to look at some indicators, and they're to do with credit, debt. I also want to look at how gold really does in a crisis period. And the last crisis, of course, we need to go back to the timeline of that crisis. And I'm going to look into that as well, to the crisis timeline and what actually gold did. And I want to touch upon as well the fact that, nothing has been done to fix things. As Gordon Brown said, he agrees with me. The banks, they've been allowed to hide a lot of things, to move a lot of toxic assets through QE to the central banks. They've been allowed by the regulators to basically account for assets in a way that doesn't represent the real world, by marking a lot of their assets and securities that they hold, marking them to model, not to the market. So what does that mean? Well, that means that, let's say your house is worth $1 million, or let's take that number, and then you have to write a report about your financial assets, and you say that, I could sell my house for $1 million. But the banks, what they do is, we're only going to sell the house in 10 years, and it's going to be worth $3 million. So they value the house at $3 million. That's what they have done, and the regulators have allowed them to do, just to, to keep things going, so that they can create all the debt and keep the consumer borrowing more and more. So let's start with the crisis timeline. So as you can see here, a lot of people think, and I've said it before, the '08 crisis, but if you really look at it, it started in early 2007, in the first quarter. Freddie Mac stops buying subprimes, government-backed entity. And then in the second quarter, American New Century Financial, largest subprime lender, files for bankruptcy. So that's still, in the first half of 2007. Third quarter of 2007, Countrywide narrowly avoids bankruptcy. Run on Northern Rock, in the UK. It was a mortgage, it's like a, how can I say, it was a mortgage provider and a bank as well, Northern Rock, or a building society as they call it in the UK. And I even remember going out with my daughter at the time in the local town, and people queuing up outside Northern Rock, and I remember taking a picture of it, which is something that hadn't happened probably in over 100 years in this country. So this was still third quarter 2007. And then you have UBS reports first annual loss in the fourth quarter of 2007. And then the Fed started reacting. First Fed TAF, T-A-F. That was one of their programs. I forgot. It's one of the acronyms. I forgot what it I forgot what it stands for. But they were worried. And then Merrill Lynch, 5.5 billion loss. And then we come to 2008. That's when I think people realized that it was for real. It was when Bear Stearns had to be acquired by JP Morgan in March of 2008. And I'll go over what happened to the gold price and the dollar a little later at that juncture. And then, of course, the crisis kept going. Lehman Brothers crisis, fourth quarter of 2008, 10 years ago. AIG controversy. So it lasted over 2 years, this crisis. What's going to be, looking back, we know that it was started because of the subprime market triggered this crisis. What's going to be the trigger? Are we in a crisis already? Maybe we are. Maybe it's the emerging markets. Maybe it's going to be credit default swaps or the cost of credit again for corporations. And I'll look into that as well. So one thing I wanted to talk about before I go further onto the debt and consumer credit is how gold reacts and the dollar index reacted in the financial crisis. So let's start January 2007 here. I've got an LBMA chart of gold, and you can see in January 2007, gold was just above $600 an ounce, maybe around 620, and then it topped at 1,031. I remember that day well. Was the day that Bear Stearns had to be taken over by JP Morgan. It was the all-time high at the time, 1,031. And then after that, gold traded back down to around 700, but still above, where it was in the beginning of 2007 when we saw that the crisis started. And then, we traded to 675. And then from then on, it just almost went up in a straight line. And then by, the end of 2009, we made new highs around 1,200, and I'm not going to cover the gold's move up to almost to 1,900, but you can see a lot of people are saying, is gold gonna drop again in the crisis like it did in 2008? But we need to look back when the crisis started, which was the first quarter of 2007, and actually gold performed very well in this crisis. It kind of doubled in the 3 years from the beginning of the crisis in January 2007 to January 2010. It doubled from basically 600 to 1,200. So to those who say that gold doesn't perform well in crisis, we need to you need to look a little bit more closely at the timeline and the chart. So what about the dollar index? Because a lot of people also are saying that gold hasn't done well, and if the dollar keeps going up, that gold is going to go down. But one chart that I've talked about in the past months ago is the chart of the dollar index and how it what it did, and this was also right around the time that Bear Stearns, had to be taken over, would have collapsed if it hadn't been taken over by JP Morgan. The New York Fed also helped JP Morgan. So it was an indirect takeover, a bailout by the New York Fed, I would say. But you can see that gold traded down to, sorry, the dollar index traded down to 70.69. That was in March of 2008. And ever since then, it's been going up. And gold at the time, don't forget, made an all-time high at 1,031. So you would think with the dollar index having bottomed there at 70.69 and now around 95, you would think that gold would be down around 700 or 600. But no, gold is at 1,200 or just a little bit below 1,200. So actually gold has outperformed, how can I say, it's even performed well with the dollar going up. Let's move to what I think we need to look at and how the debt has evolved. So one chart that I think is interesting to look at is the, and this is from World Gold Charts, and it says US debt and debt limit versus gold. And this chart says gold and US debt have positive co-monthly correlation of 87%, 7/8. You know, it's quite a high correlation. And you can see here from 2000 with the national debt, which is the black line, going up. Gold has been going up. Sorry, the black line is the US debt limit. The national debt, of course, is the US debt. And they were able, you know, this debt ceiling or limit was kept unchanged for a couple of years, and that kind of kept gold low. But right now, with the debt, you can see is going over 21 trillion. Gold is still at 1,200. It's still at the same level of when the debt, the national debt was around, let's say, 16 trillion. So I think that's, you know, a divergence. It's diverging quite a bit. And I think for gold to catch up with the debt, we need to be somewhere around 1,800, 1,900 now. And I think we were also going to see maybe the fact that it stayed at these low levels, which is unnatural in my opinion, will make it a spike above the trend. So that's another interesting chart. And then, you know, you look at stories that came out this week, last week. This one was amazing. U.S. government spends a record $433 billion in 1 month as deficit explodes. So, I mean, this is it's getting crazy. I remember Franz Pick in his book talking about the book is here. Hold on a second. It's this book here, The Triumph of Gold. And he was talking about in 1986 how it was amazing that the U.S. Treasury was running a $200 billion annual deficit, and now the U.S. Treasury is running almost $500 billion per month. I mean, this is just going crazy. That chart I just showed you about the national debt and the debt limit, debt ceiling with gold, that's going to get even more out of whack. And that's why I don't see gold going down that much more. Let's look at the consumer debt. I thought this chart was really interesting. This is from wolfstreet.com, and the source is the Federal Reserve Board of Governors. This is total consumer credit, not seasonally adjusted. You can see we had the 07 to 09 crisis, and it topped around just below 2.7 trillion total consumer credit. We had the crisis, and it dropped a bit, and then they threw everything at it because that probably would have kept going down, that net consumer credit. And look where we're now. I mean, it's gone up by 48%. It's even worse than it was during the 08 crisis. So the other thing that could be the trigger, I would say, for the next crisis is the derivatives, and you need to keep an eye at, let's say, 5-year CDS spreads. Well, this is the spread between investment grade and also high yield CDSs against how can I say sovereign CDSs, which are supposedly the less risky credit. And you can see that in the '08 crisis, how that spiked. And when you have that kind of spike in CDS or the cost of credit, well, that actually means that the market has no confidence in the high yield or investment grade securities or credit. And that's why the cost to insure these credits go through the roof, and these companies they lose all the credit. The just-in-time economy collapses, and that's why you got the Great Recession. And as you can see, the debt hasn't gone down, the government debt, the consumer credit hasn't gone down. And right now, I mean, this is from the end of 2017, and I don't think it's gone up that much right now, but it's a bit of under control. But I think that's what we need to keep an eye on. When that starts spiking up, look at. To finish off, I'd like to show you, because there's a lot of talk about a lot of times that China's going to bring the world economy down, but I found this interesting chart here. It's like a pie chart, and it says percentage of world debt by country. I mean, this stands out. United States, share of global debt, 31.8%. Japan, 18.8%. China, 7.9%. But the interesting thing about this, if you combine that, if you look at the how these countries, what share of world GDP they have, the United States, according to 2018 ranking, has 23.3% share of world GDP. Yet they've got almost 32% of the share of debt. So that's not good. The worst one is Japan. They've got 18.8% of the share of debt in the world, but their GDP is only 5.9% of a share of the world GDP. And then I wanted to look at China, and actually China, that's why I don't think the debt problem will come necessarily from China, because you can see that they've got 7.9% of the debt in the world, China, yet their GDP is 16% of a share of world GDP. So I actually don't think, I think I would look more at the United States and Japan. Even Italy's got almost 4% of the world debt, and their economy is only, their GDP is only 2.5% of share of world GDP. United States is still, the big, that will be the big problem. The big, the crisis might be starting in the emerging markets, but you can see that the emerging markets, a lot of the debt that they have is very small as a percentage of world debt. They might just be the triggers, but the really big, show, when you can take out the popcorn and watch it live, it's going to be the US, Japan, Italy, the United Kingdom. Will these people be right? Are we near a crisis? Maybe. You look back, if you do the maths, 1971, I guess, you had the Bretton Woods collapse. Nixon closed the gold window. You go to 1980, when the dollar and interest rates spiked in 1981. That's about 10 years. The U.S. interest rates in the U.S. spiked to over 20%. 10-year yields were at 16. So that's 10 years. And then you have the 87 crash. That's 6 years, but it didn't really it did lead to a recession, but it was a little later in 1989, 90. So I guess, yeah, 8, 9 years. And then you get the Asian crisis in 98, which was a precursor for the dot-com crisis. And that was in 2000, 2001. So again, in that range of 8 to 10 years. And then you get the 07 to 09 crisis. And you could argue, yeah, that took about 8 years from 01 to about 09. So we're definitely, you know, now we're in the 10th year of this supposed recovery. So we are close. And of course, nothing has been fixed. The debt, as you can see, has gotten even worse. Not only government debt, but consumer credit. Don't forget, you need to hold on to your physical gold and physical silver. As you saw there, gold actually went up during the 07-09 crisis. It did have a few fluctuations, but as a whole, it held steady, and it's even doing, it's even gone up, you know, since 08. Even though the dollar index has gone from 70, just under 71 to around 95. Gold has gone from 1,000 to 1,200, and it went even higher in 2011. If you enjoyed this video, please like, share it far and wide, subscribe to my channel if you haven't yet. You can also follow me on Steemit, DTube, and on Twitter. I'll talk to you later. Take care. Bye.